The entire stock market rests on these three charts that I'm going to show you right now. Let's take a look. So the first chart right here is honestly really, really big, and it's really important for you to understand this. And then the third chart that I'm going to go into, honestly, is going to tell us pretty definitively if the market's going to go up or down from here. So let's break down this one first because honestly, it's really, really important. So the lighter line right here corresponds to the S&P 500 index right here. So you can see it's very jaggedy going up and down. This goes from 2015 to current. And the darker line right here corresponds to the earnings of the S&P 500 going forward 12 months. So it's the forward earnings per share. Now you can notice the trend. The S&P 500 typically follows what their earnings do. And when you zoom out on an even longer time period, this pattern becomes even more obvious. Stocks typically follow what the earnings do. So whether it's an index like the S&P 500 or Nvidia or Tesla or whatever the stock is, usually the way that the earnings go is the way that the stock is going to go. So we can make some really good observations by looking at this chart right here. So let's look at this dip right here first. So this was the COVID dip that happened. Market went straight down. Fed started printing money. Market went straight back up. But you could see the earnings growth line right here. Earnings did go down during COVID, but the market actually went down more than what the earnings growth actually did. So usually in the long run, the market wants to follow this earnings growth line. So the farther that the market actually gets below this earnings growth line right here, the more likely the market is to rebound and go back higher. I talk about this as the rubber band analogy. Basically, the market just bounces above and below the mean line of growth, but eventually the market goes back to the mean line, which is called reversion to the mean. So stick with me here. So you can see this whole time period right here, earnings are going up quite a bit, but the market is riding above it just a little bit this whole time period right here. Then the market topped out right here when inflation went over 9%. The Fed started to raise interest rates, which we're going to go into that in chart number 2, which is massive to know what's going to happen in the market right now. So they raised interest rates. Market went way down over 35% on the NASDAQ. I understand this is the S&P 500, but the NASDAQ did go 35% down in this time period right here. And you could see a very clear trend right here. You could see that the earnings growth line right here is above what the actual index is trading at. So you can see right here, the stock market's honestly like stretched down like a rubber band. The more that you stretch the stock market down, the more it wants to revert back to the mean line of growth. So you can see the more we dipped below this growth line right here, the stock market pretty much did a boom and went right back up pretty quick. But now you can see this big issue that I'm kind of pointing at right now. The market is getting disconnected from the fundamentals. The earnings growth is still growing pretty good, but the stock market went up way more than what the earnings growth actually did. Now you can see the dip right here that we're experiencing in the S&P 500. The market is now reverting to the mean. So one of two things has to happen, or both of them could honestly happen too. So in order for the stock market right now to not technically be overvalued and kind of be like a bubble, I mean, it's not a surprise that Warren Buffett has so much money in cash on the sidelines because he sees that there's not really deals in the market right now versus over here there were some deals. So one of two things has to happen. Either the earnings of the S&P 500 companies has to go way up, or the stock market has to fall until these two lines meet right here. So essentially, where these lines intersect right here, this is considered to be intrinsic value for the market or pretty close to it. Nothing is obviously perfect, but that's when you know that you're getting in at a decent price. But right now, you can see the market started to correct lower, and people are saying, oh, go buy the dip. It's the time to buy the dip. But honestly, we could go a lot lower. So just think about it. If the market falls all the way down to the earnings growth line right here, and then we go to the left, that would mean the S&P 500 fell to $5,100 per share. Now that would be quite a discount. That would almost be another 10 to 15% drawdown from the levels that we're at right now. Now, also what can happen, which a lot of people are expecting to happen, is the earnings could go up way more in the quarters going forward. So if this line right here starts to go vertical and accelerates, that's going to make these two lines closer, assuming that the S&P 500 does not pump and eventually go away from it again. So I think right now, based on this chart right here, we are going to have a bumpy 2025. I'm not saying we're going to have a market crash, but I'm saying don't expect to have massive stock market returns overall for the year. I'm predicting somewhere around a flat return, but next year I think we're going to get back to growth. But for this year, I think it's healthy that after we had this massive pump in the market right here, two back to back 25% years, a correction is okay to give a little bit of the gains back. Now, looking at chart number 2 right here, you have to look at what interest rates are doing. So interest rates are like gravity on the stock market. If interest rates go up, this is the risk-free return. So think about it. Do you want to invest in the stock market at these levels right here where it's kind of expensive? There's maybe a bubble, there's tariffs, there's inflation, there's the economy going down the tubes potentially. There's all this bad stuff potentially happening in the market right now. So people are getting nervous. So what happens is people go buy the 10-year bond and they're going to get that guaranteed 4.18% return on their money every single year, no matter what, as long as the US government does not default. Of course, if the US government defaults, we have bigger problems than, money at that point, but it becomes compelling to go buy bonds right now because there's so much uncertainty in the stock market. But here's the key thing that is the bull case for the stock market. You can see right here, ever since, January of this year, we peaked out around 4.78% on the 10-year bond, but now we're at 4.18%. So bonds are actually going down in yield, which makes them actually less attractive. So as bonds are falling in yield, they're less attractive. On top of that, the stock market is correcting, which then makes the stock market a little bit more attractive because it's now cheaper on a fundamental basis. So those two scenarios right there kind of point that the stock market is becoming more attractive as it's falling. And honestly, I do agree with that. But the key thing that people have to understand is that the market could have a long way to go until we get to true intrinsic value. We want to see these lines overlap like they are right here and right here. We are still disconnected. So understand that as the market falls, it's becoming cheaper, it's becoming safer. But the chart that we have to look at that really changes everything to know if the market's going to go up, go down, and what it's going to do in the future, we have to look at the chart right here of the NASDAQ to see where we came from and where we're probably going to go into the future. So if we start off here on the left-hand side, this is the dot-com crash. You can see the triple Q index, which tracks the NASDAQ. Of course, this is all split adjusted, but it's still the same percentage move. You can see right here on the peak, it went from $230 per share all the way down to $19 per share. So it dropped roughly 90%. The NASDAQ index fell over 90%. So a lot of investors are wondering, are we in a situation like that right now where this dip right here could look something similar to this? Honestly, I don't think that's the situation we're in right now. Let me explain. So you can see right here, we had the 2008 crash, which honestly just looks like a little blip on the chart. And then we had this massive pump right here going into current times. So then looking at this dip right here, this was when COVID happened. And honestly, when COVID happened, everybody was freaking out saying the market's not even going to open anymore. The recession's going to last forever. All this crazy stuff is going to happen. Of course, it didn't actually play out like that. But when you're in the depths of problems with the stock market, it is hard to see the optimism on the other side of it. So when we were deep in the depths right here in COVID, there were so many companies that maybe would have went belly up. There's so many things that moved online. There's so many brick and mortar stores that had no one going in. There was no traffic. These businesses were not established to really do business online. So there's a huge technological shift that happened during COVID right here, where a lot of companies went online and they went remote, which panned out to be a little bit more efficient for their operations. So this dip right here happened. The Fed printed a bunch of money and the market rebounded pretty quick. As we printed all this money, inflation started to go through the roof. Once inflation went through the roof, the Fed raised interest rates. Remember, interest rates are gravity on the stock market. So as interest rates went way up, the stock market went down because now, interest rates, if we go on this chart right here to all, you can see interest rates were roughly 0%, but then they raised interest rates all the way up to roughly 4.5% from basically nothing. So that's a 4.5% interest rate hike in a very short amount of time. So the market didn't like that. The market corrected from roughly $400 a share all the way down to roughly $261 per share. So that's roughly a 35% drop, all for the fact that interest rates went up. Now, I'm going to make a bullish argument right now for the market, and then I'm going to make a bearish argument, and then we'll wrap it all up. So Triple Q peaked out a couple months ago at $543 per share. You can see right now we're down at $472 per share. It's been a very quick drop down. Let me zoom this chart in a little bit. This is a 1 month chart, all the way from basically 540 all the way down to 472. So back to a 1 year chart, the market pretty much pumped straight up from when Trump got elected because everybody was like, he's going to be pro business, he's pro stock market, he's pro deregulation, he's going to do whatever he has to do to support the stock market. So there was this big, massive euphoria hype train to push everything up sky high. Stocks like Palantir went up, Tesla went way up. All these stocks got extremely disconnected from the fundamentals. And then bam, Trump starts to strike a stance on tariffs that nobody wants to hear. He's being stern. He's basically telling companies you have 1 month to bring your business operations into the US or you're going to face massive tariffs. I mean, companies like Ford and GM, they're terrified right now because they have so much of their operations based in Mexico that if these tariffs really go into place on these companies that really have low profit margins to start, there's a very high chance they're going to get totally destroyed. So the market is very, very bearish right now. Everyone's saying that this is going to cause inflation. That means interest rates will have to be higher for longer. So maybe interest rates are going to end up spiking back up on this chart right here. Let me flip back to a 1 year. So maybe interest rates spike back up, and then it's going to make bonds become more compelling, and stocks are going to become less compelling. So maybe stocks will fall even more. It'll kind of look like the dip. Let me zoom out again right here. It'll kind of look like this dip right here that happened in 2022. If rates go up, usually the stock market's going to go down. So we're still going to need time to see how this is all going to play out. Me personally, I have a lot of buying power on the sidelines right now, just in case the market happens to fall a little bit more. But also, I'm not getting complacent. I am not getting emotional. I'm keeping my emotions in check. I am not selling out of the market. I'm a long term investor. I'm going to ride out these dips. But if we zoom out and we go to a 5 year time period right here, you can see the progress that the stock market made. I mean, a triple Q index went from 169 per share all the way to 472 per share. I mean, that's a massive gain that happened over a 5 year period. So to give a little bit back, I think that's healthy and that's okay. But if you want to watch a really good video, my 7 key habits to understand how to make millions of dollars in 2025, watch the video below. I linked it in the video description. I'll see you guys there.